Imagine a vast cosmic dance of celestial objects, stars, planets, galaxies, all interacting through the fundamental forces of nature. In the world of finance, a similar dance unfolds. Companies, investors, and capital engage in a complex interplay. One of the most intriguing mysteries in this financial cosmos is the question of capital structure. How do companies decide on the right mix of debt and equity to fund their operations? For decades, this question puzzled economists and business leaders alike. Some believed that a company's value could be enhanced by carefully balancing debt and equity. Others argued that the specific mix mattered little in the grand scheme of things. Then in 1958, two economists, Franco Modigliani and Merton Miller, published a groundbreaking paper that shook the foundations of financial theory. Their work, often referred to as the M&M theory, provided a new lens through which to view this intricate dance of capital. Like a telescope revealing hidden wonders in the night sky, the M&M theory offered a simplified and elegant explanation for a complex phenomenon. It stated, under certain assumptions, that a company's value is determined by its ability to generate profits from its operations, not by how it is financed. This revolutionary idea sent shockwaves through the world of finance, challenging conventional wisdom and sparking decades of debate and research. And the Modigliani-Miller Theorem, in its essence, argues that the market value of a company is independent of its capital structure. Picture a company as a factory producing a stream of future cash flows. These cash flows, like starlight traveling across vast distances, represent the true value of the company. Modigliani and Miller propose that this value is determined solely by the risk and return profile of the company's underlying assets. Think of it like judging a cake by its taste, not by how it is sliced. Whether a company chooses to finance its operations with more debt or more equity is irrelevant in a world without taxes or other market imperfections. This concept, known as capital structure irrelevancy, is the cornerstone of the M&M theory. It suggests that in a perfect market, investors can replicate any capital structure a company might choose by borrowing and lending on their own. They argue that investors, like cosmic explorers charting new territories, will always seek opportunities to maximize their returns while managing risk. If a company's capital structure doesn't align with their preferences, investors will simply adjust their own portfolios accordingly, leaving the overall value of the company unchanged. The first proposition of the Modigliani-Miller Theorem, often referred to as Proposition 1, formalizes this concept of capital structure irrelevancy. It states that, in a world without taxes, the market value of a company is independent of its capital structure. Imagine two identical companies, one financed entirely by equity and the other with a mix of debt and equity. According to Proposition 1, these two companies would have the same total market value, even though their financial structures differ. This is because the total value of a company, like the total energy output of a star, is determined by the present value of its future cash flows, not by how those cash flows are divided between debt and equity holders. Think of it like this. The total amount of water in a lake remains the same, whether you choose to draw water from the surface or through an underground well. Similarly, the total value of a company remains constant regardless of its capital structure. The second proposition of the Modigliani-Miller Theorem, known as Proposition 2, dives deeper into the relationship between risk and return. It posits that the cost of equity for a leveraged firm increases in proportion to the leverage ratio. This is because as debt increases, the risk borne by equity holders also rises, demanding a higher return to compensate for this added risk. In a way, it's like walking a tightrope. The higher the tightrope, the greater the risk, and the more skill and balance required. Similarly, as companies take on more debt, the financial risk heightens, necessitating a careful balance between risk and return. Proposition 2 underscores the importance of understanding the trade-offs involved in capital structure decisions, reminding us that while debt can amplify returns, it also magnifies risks.